Hello, folks. Welcome to Pro Trader Strategies. My name is Eric Wilkinson. This is our webinar on swing trades using options. So what I'm going to do in this video is talk about how we spot good setups using swing trade setups, candlesticks, support and resistance, all of those things. And then what we're going to do is look at that underlying that we found a directional assumption with and find the best option strategy that fits that assumption. With this one, what we're looking at, and I talked about this earlier today in Spot the Trade videos. So those are our daily market videos that I talk about all my trades. I talked about Citi today that I was going to be looking at this type of trade because I want to eliminate any type of downside risk and look for a neutral market assumption with this underlying. I'll go into that detail here in a little moment. But first off, let's get into the nitty gritty of what really is a swing trade here. So I guess you don't want to change. There we go. All right, swing trades. This is going to ultimately end up with the broken wing call butterfly. Now, the call butterfly is a neutral market assumption type strategy, but this is going to eliminate one of the directional moves here. We talked about this a little bit last week with the broken wing put butterfly. Now we're looking at the broken wing call butterfly going forward. But first, let's talk about swing trades and what is actually a swing trade. A swing trade really is simple as it is, just trying to come up with some support and resistances or finding where the underlying loses momentum to the upside or catches support to the downside. And sorry, folks, my glasses are starting to steam up a little bit. I probably need a little bit of a dab here. Not feeling the hottest. So I've never missed a webinar. So that was scheduled. So I felt if I'm just in here, I'm gonna try and get through this with you folks, just in case. I might be the TD Ameritrade guy. Remember, or E-Trade? Remember the E-Trade kid that threw up in the bucket? I brought the garbage can in here just in case. So bear with me, folks. All right. I will get through this because I want to make sure you folks are all clear of concept. All right. First thing we're looking for a swing trade is the overall trend. What is this underlying been doing the last, say, 52 weeks? If you're on a daily chart, then you would go into a daily chart. I stay away from the daily charts anymore. I'm trying to do a little bit longer swing trades, if you will. But ultimately, what we're looking at here is general markets, right? We got a bullish move. We've got our bearish moves. And then we have our market neutral moves. Folks, I'm not, like I said, completely on top of it. If you catch me misspeaking, slap me around a little bit. Throw something over there in the comments section for me, all right? Make sure I'm keeping everybody else on task here. All right, so bullish assumption. You know, markets don't go in a straight line, really. We have ebbs and flows going on, right? So the markets kind of do stuff like that. And market neutral, same thing. You might see them kind of pop back and forth, but ultimately what we're looking for is those types of patterns where we can kind of see where the underlying loses momentum to the upside and gains support. And yeah, it sometimes will break through those support and resistances. I'll talk about that here in a moment. But one thing that we want to know here is after we find our support and resistances, then we want to see what the pattern reversal is off of those support and resistance. Yeah, we could be talking about an overall bullish. Thank you. Sal said, can't see the screen. All right, what's happening here? Why am I not? I'm not sharing. There we go. So backtrack a little bit with swing trades. We have our overall bullish move, right? Market neutral, and then bearish moves. And then the markets will have an ebb and flow to them, right? After we've seen that, found the support and resistances, the next thing we want to key on is coming off of one of those supports or coming off of a resistance. It doesn't matter if it's a bearish trend with a bearish pattern or a bullish trend with a bullish pattern. I just so happen to kind of draw that up that way. But ultimately, it could be either way. You could have a bullish and then look for that bearish pattern off of that. Now, for folks that are newer to trading, especially based on these types of fundamental analysis or technical, and I should say technical analysis, not fundamental, but more technical analysis. The idea here is if it breaks through your resistance area, you wait for it to re-enter into that area. So for instance, this might come out, but once it re-enters on that pattern reversals where you're going to look to take advantage of that, okay? Does that make sense for everybody? Same thing with the bearish, it could pop up there and we would play it off of that move, all right? So swing trades, just a little bit of quick review. The overarching trend is what we're looking for just to base, give us a little bit of wiggle room. Well, it's an overall bullish trend, so I'm probably a little concerned about the upside, right? Bearish trend, I'm probably a little more concerned about the downside than the upside, and that's exactly what would make a trade work with the broken wing butterfly. Now, I like to build from simple concepts to real life examples, folks. If that's something that appeals to you, please smash that like button for me, because I think it kind of gets it set. If we can separate some of the technical stuff that goes on with trading and start breaking it down to simple steps, then I think you'll be better off there. So with this said, this is an older snapshot of IBM. The reason why is because I've traded IBM for the last 20 years. And it really, folks, has not gone anywhere. So if you're newer to trading and are looking for swing trades, IBM is a really good one because it has a tendency to stay within this range. And yes, it has broken out. But you know what? I started trading in college, and yes, I'm dating myself. It was back in the 90s. This was one of the first stocks I bought. It never went anywhere. So I started doing covered calls and selling puts when they got called away from me, and it never went anywhere. I get out at like 110 and then get back in the 90s. Now we moved about $10 higher, all right? Call me crazy, but still in that range. All right, so if we're looking at this, then we would kind of glaze our eyes a little bit, and you will be able to see the market's ebbs and flows, which is what we're looking for here, right? So we're getting some ebb and flows. Now we're starting to get what looks to be a rollover there. So I don't lose everybody. Some of you folks that are newer to trading around candlesticks, some of the key candles to look for at the top of a move like this one is, all right, or at the bottom of a move. I don't see one right now, of course, but at the bottom of a move right there, those are things we're looking for. So this is at the top of a move. This would look like it's starting to roll over. Now, more aggressive traders like myself will have a tendency to jump on when we see this type of candle at the top. So the candles you're going to, and the reason why is they indicate the reversal of momentum. And we've got one of these right there, which is basically a hammer. If it's flipped, it's a hangman. All right. You can also have them where they have a little bit of a wick. All right. And or on the bottom. All right. They all have different names. Like when it has that little wick at the bottom, this is a spinning top, the hammer, or sorry, the hammer and the hangman. Another one is the tombstone. All right. That's another good one to look for. It's a very rare candle, but the tombstone is a pretty good one. Shooting stars, like if it were to say finish a big move there and we would see the market say jump higher or gap, that would be something you would look for. Like if the underlying had a candle right in front of it like this, then it gaps higher. That's considered a shooting star. So you can look for that one as well. It doesn't happen very often. Usually the ones that are going to happen are these over here. And keep in mind, it can be a green candle. It can be all of those that it doesn't matter what color it is at the top of or bottom of a move. It's really just looking for those type of candles. Now, if you are, again, newer to trading options or around these candlesticks, if you were to get the confirmation, like a candle that starts trading down here, all right, a finish below that previous day bottom is what we're looking for on a bearish settlement. So that would indicate that the market is confirming that top. Now, when I got involved in this trade, during these videos, it was way back at the beginning, we started talking about this type of trade. Now, I didn't wait for it to get confirmed, and it popped to the upside. But one of the things we were looking at is selling calls at the 137 strike, okay? And the reason why we were looking at that is I had 2 resistance areas above me. Now, sometimes we can see that first resistance area get blown through, but that second one will hold a little bit more strength. And we see that here in IBM. Now, if you're newer, wait for that second line in the sand there. That would be where I'd probably look for trying to enter this trade if I were newer, or the confirmation like we have here. Those are 2 things that you're going to look for. You are not going to get as many opportunities if you're waiting for this second resistance line up here, okay? As you can see, had I every time traded as soon as it got up near that resistance area, you would have done very well throughout the year, even on the support. Now, like I said, with these breaking through the support here, you would wait for the confirmation coming back in to the market. You would not be trading right here. You would be looking for the market to break back up into our trend channel. Okay, does that make sense for everybody so far? Because I'm going to move on here, show you how scary it could be if stuff like that. Actually, it's down the road a little bit. I hope I didn't get rid of that updated one, but we'll check it back out. Now, City is what I'm looking for. Why? It's not confirmed yet. Obviously, this was today's. I took a snapshot of this. We are not confirmed here at the top, but a confirmation is what somebody would look for Monday for this to start rolling over. Now, if you guys watch what I talk about when I'm trading, we've got the point of control, which is this POC right here. That acts, I always talk about it, acts as a magnet when you're trading, okay? Because that's where time and volume has been accepted. What I mean by that is when you get these big outstretched volume nodes like this, that is the acceptance of value at that price. Meaning everybody who basically has been trading this realizes that $52 and basically 20 cents is what is considered value for this underlying. And that does it across the board with any other underlying as well. This is just a really good example of it. So I would look to enter this probably on the candle. If you are newer to trading, go for the confirmation. All right. So I am looking for a relatively neutral pattern, not very good line, but very neutral pattern here. And we have come up against this resistance area. I'm looking for it to roll down at least back to the point of control here, or maybe a little bit further. Find some support on this 50-day simple moving average here, okay? Because that will act as support as well, those 50-day simple moving averages. And then we could why would we want to use options? I mentioned one thing, but what we're talking about with this IBM trade that I had on, I entered into this trade right here, selling the 137 calls way up here. Because of the volatility, I got a huge premium for those. So I was able to get up to that 137 area. It went up there and tested me, which is not surprising whatsoever when trading options. Now, a lot of folks would say you got set up on this hammer doji here. The next day we blasted off. Folks, I blew this rule right there. If a settlement above the previous day's wick there should have gotten me out, but it blasted off, and by the time I caught it, I was just like, I'm going to stick with this. It is way overdone to the upside. So I stayed with it and waited for the market to roll over. I did not add to that position. I don't most times add to that position. All right. So another thing, if we go back to where we were looking at IBM, this is what I wanted to pull up here, is these are the areas we were talking about at the end of that last chart. So you can see a lot of time has passed, but I still believe in IBM's candlestick patterns. We got a bottoming pattern. It rolled higher off of their earnings. Now, finally, some investors are starting, well, at this point anyway, investors were starting to actually give credence to IBM's cloud services. And I've been talking about this probably, for some of you folks know, for 2 or 3 years now, that I've been pretty bullish of IBM to break out of this trading range. It just really hadn't, because of this cloud service. This cloud services has very high margins, and their service sector has very low margins, and you have to deal with employees. Well, the cloud services, not so much, right? But you can see what happens is we get this big rally, and what did we see happen? Came all the way back down and has started re-entering into this area. So this would have been the place to start looking for it, and I would probably still consider these two lines in the sands to the upside to be my resistance if we're able to break through here, okay? So that's what I'm looking for. This is a point of control, so it could very well want to hold on to these price levels here for the foreseeable future. I'm not setting a trade up on this. I just wanted to show this as an example. Yes, sometimes it feels like it's blowing out to the upside. Folks might be even saying, hey, if you were short that underlying, it would have been very painful. It would have been very painful. I'm not going to lie. But you could have traded in and around this underlying during this consolidation, lower cost basis, all of those things which we talk about in those spotting the trade videos. I don't have enough time to do it justice here, but we do go over that. So we broke out to the upside here, close to the point of control. I'm not necessarily waiting for that confirmation. As of today, I just kind of set it up the way that everything was looking. We have really high implied volatility here with this underlying. Like I said, I've got a neutral to bearish assumption here, and high volatility. So when we see that volatility spike, well, we know when volatility gets up at these levels, a couple of things with options that some of you folks probably know, and maybe some of you don't. So I'm going to just go ahead and say it, right? That when volatility increases, our premiums in the option montage, which is where you see all the strike prices and everything, those prices are increasing incrementally higher every time volatility moves higher, and vice versa. If volatility starts going down, then we start seeing those premiums come out, even if the underlying doesn't move, even if a day doesn't go by. So when volatility is at extreme levels like we're seeing here, we want to take advantage of high prices. Now, another thing to note with volatility, it's always a neutral pattern. It can break out of resistance areas or support areas, but for the most part, every underlying has its own implied volatility coefficient, if you will, meaning that when it gets, for instance, with Citi up to this 60 level, when it gets up near 60, it starts losing some of that volatility in there. And then when it gets down here, let's say near the 28 or 27-ish area, then it starts gaining some support. People start buying more options. That is the levers and pulleys of options. You should take advantage of that. When volatility is low, that means premiums are cheap, all right? So look at this implied volatility and understand that at extreme levels, they're expensive. All strike prices for this underlying are expensive. And when it's really at those really low levels, that's when they're cheap. So buy cheap, sell expensive, right? In that, with this strategy, we want to collect a credit. Whatever we're doing with this underlying for our market neutral or bearish assumption, I know going into it, the option strategies that are debits are pretty much out the window, all right, with very few exceptions. High volatility, collecting a credit is what we're looking for in trades like this. So now I'm going to go over this a little bit more with call butterfly. Before we break this wing, it would be a debit, which means I paid a debit. I don't want to do that when volatility is really high and those premiums are expensive, right? I just got through saying that's when it's going to cost us the most. So with this strategy, we can take this from a debit spread and we're going to synthetically sell a call spread, all right? And I'm going to go into this. Like I said, I try to build from simple concepts. I want to talk through this and then I will show you. So we're going to embed synthetic short call spread in there, and that will pay for the entire strategy. All right. We never, if you walk away from this video and the only thing that you guys take away from it is a broken wing call butterfly I should not do for a debit, then that's perfectly okay. Because with this strategy, a normal butterfly would look like, let's say, for instance, if this is the line in the sand, a regular broken wing butterfly will look like this and come up to a peak and then back down to the same level and across. So it's defined risk on both sides. Now, for the broken wing call butterfly, we are going to break a wing, all right? And we are going to sell a call spread, a synthetic call spread, and it's going to create a situation where then it looks like this. And it comes down and cross. So if the market sells off, there is zero risk to the downside. And if it stays right here at that market neutral assumption, you can see that I get max profit. All right. But also know, actually, so this is basically the level of the previous. This leg break would make this more risk to the upside. That's a little bit of the dramatization there, but the breaking of the wing will allow us to have the risk to the downside. And this is basically where I'm telling about having a short call spread embedded into this butterfly. Okay. And I'll go into that a little bit more and show you how that works out. Probably towards the end, I'm going to pull up the platform. We'll go through this. Don't have just all slides here. Again, we got the high volatility market wanting to roll over there. So let's go from the butterfly, which is normal. And we look at selling the 50 calls here, right? So selling the 50 calls mid-market, I did this after the close because I wasn't feeling so good yesterday and didn't know how this was going to work out today. But when you sell one of these calls to build out this strategy, because you can see that when we're doing the butterfly, we're doing two of the at the monies. So you sell two. So we're selling, let's just say a call and a call right there at this strike, okay? And then we're going to buy a call right down here at the 45 strike. So we're buying the 45 strike. So I'm buying a call. Now, when I look at this mid-market, I'm saying this is probably closer to $5, which is the amount I'm really looking for to collect that credit when it all builds out. So when I look at that $5 that I can collect, that tells me how far I can go to define this risk. Meaning I could collect $5 for selling this, the 50 call, and then that means I need to go $5 that way, okay, to define that risk. Now, again, to the upside, that means it's $5 to the upside, and you can see that the spread was done for a debit that way because of the buying of this strike right here. So that's where we bought the call to define the risk on the butterfly, right? So the idea is when you have this set up on a platform is you are going to click the sell that call, and then you're going to go out another strike and buy a call. So this is that kind of synthetic call that I was talking about with the butterfly. So we can see this is that defined risk that I was talking about. But when we break that wing, and as you can see here, breaking that wing and going to the 60, I'm able to get a slight credit. Like I said, don't do this strategy if you cannot do it for a credit. There is no reason we should add risk to this side. We're adding risk to this side to eliminate or zero out our risk to the downside. Okay? So I don't want to add risk to one direction and still have risk to the other side. I would want to completely stay away from that scenario. If you're adding risk, anytime we add risk, folks, when we're trading options, is if you add risk, you should increase your probabilities of success. When you lessen your risk, you decrease your probabilities of success as well. Risk equals reward. So what we can see here is breaking that wing. We've gotten this to where if the underlying goes that way, there is absolutely no risk to the downside because of the credit I received. All right. But you can see by selling that call spread at the 55 strike, by selling the call spread here, which was where our other strategy was defined, right, at 55. So we sell the 55 call and then buy the 60 call, which is basically right here. And then we buy the 60 call. So this is a short call spread, right? If you're selling a 55 call and or buying a 60 call, that is creating a short call spread. You don't ever see it, but except for when you would go through this process of kind of legging out of it. And I'll show you, I might as well get to that now. Since I'm talking so much about it, get on with it, right? All right, so let's pull this up, go to the trade. I was looking at Netflix for a bearish move as well, but the problem is they have earnings coming up. So I want to stay away from this strategy with earnings. And we were looking at Citi. So let's go back to Citi. All right, guys. All right, Citi, let's go in here. And I'm just going to go through the steps. It probably won't work out real great right now, but let's look at it. When we're looking at selling the 50 calls, I'm looking at, I think I'm going to collect at least $5 for this. But that's what makes me, because it was more mid-market. The market's moved a little bit since I started setting this up. So we'll go with it. So 450 is probably where I'm really at. I'm just going to change it. And so that's about $5. That's what tells me I need to go $5 to define my risk. So I'm going to hit that again and then buy that one. And I still have a credit because of the way that you get 2 times, so $9, and it's going mid-market on the buy there. Now, before, what we were doing is looking at equal distance for a butterfly. So I want to come in and buy that one. That creates the actual butterfly. And we could go over there and look at the analyze tab and all of that. But what I want to show you is now we sell the 55s. You can see it kind of got rid of it's going to be a little bit dramatic, and then buy the 60s. So in a sense, you can see where that one disappeared there. So let's go through this just so that I get it all set up here for you. So we're going to go selling that one. I'm just going to make it 450 to make it realistic. All right, so I've got that one. I go $5 because I'm collecting about $5. So I'm going to go $5 down, buy that one. Now, here's where we were buying this one before, right? You don't want to work. All right, so we got $5 equal distance. This would look like the butterfly that's probably still over there and going to mess everything up. What's happening there? 2020, I don't know why that's looking so funky and doesn't have everything, but that is not right. Oh, so here, we'll do it here. It is right. So if I were to sell this, right, sell the 55s and drop it to the 60, you can see there that collecting, that's why it was, had a lock in there for the debit. Anyway, we'll have to go back and try that again. So 450, why is that showing? Oh, there we go. So break that. Let's just go through the process here. Sell that one, buy this one back in, and it's not working out. I'm not sure why. Could be because it's after the hours. Buy that one, and then I still have a credit. I sell that one, buy this one, and I should have, it's not working out. The markets are too wide right now. Anyway, I don't know what I'm trying to do wrong there, but what we ultimately want is for it to look like that, not like the last example I just gave you. If you do this strategy and build it out and it's still a debit, we need to walk away, reevaluate, come up with a different scenario, maybe short calls or a short call spread or something like that. But at the end of the day, I want to have it to where I'm basically risking one to make one in this strategy, right? I've increased my risk to the upside, but my risk to the upside is only equal to my max profit, which is pretty good. Probabilities of me getting that max profit are not that great. But one thing to note with this strategy being right there lined up with this 55, this is about a 40 delta, which means everything this way is a 40% probability. That means that everything that way is a 60% probability. All right. So we're risking one to make one, and we got a 60% probability of success. Pretty good probabilities, especially for trading. And then what we can talk about here is the nuances of the traditional butterfly. You got to nail that number, right? You got to hit it right on the peak that we're talking about there. And this is our bell curve here, which looks very similar to that. And that's because when we hit here, the probabilities are pretty slim that we're going to nail that number right on that top. But the beauty in this strategy is that I have taken it where the butterfly looks like this, right? And I've changed my probability. So what's happened here is that 40 probability to the upside or 60 to the downside really is going to line up very closely to right around this 40 delta is what we were kind of talking about there. So the probabilities of this happening versus this 60% happening. Okay. Does that make sense for everybody? All right. Well, then I guess I got a little ahead of myself. I will stick around. Probably felt like I was talking a little bit fast today. So I will stick around if anybody has any questions, comments, or anything else, but this is your offer. I'm going to throw this over there in the chat window right now for you. You guys can hit that link as a hot link. This is not going to be there. That should show up everywhere though for you folks. So click on that. Make sure you take advantage of this. For 36 bucks, you guys get over 15 hours of content. Literally, we're doing it at a price that we're probably losing money on because of all the advertising and everything else we go with this and time spent. But rising interest rates is something that I want you guys to really key in on here because folks are talking about that everywhere. And even if you have an environment where interest rates aren't rising, folks, but they do the taper, which means they stop buying bonds. Well, we talk about this. If they stop buying bonds, what happens to interest rates? Does anybody know? Interest rates, what we look at it as is a teeter-totter effect. You got your interest rates here and you got your price here, right? So when we're looking at the bonds, you can look at the futures, and if you see bonds going down, that means that interest rates are going up. Like I said, it's a teeter-totter. That's what happens. So how are bonds staying up right now? Well, it's the Fed. The Fed is out there buying treasuries to suppress interest rates. So they're trying to buy their own interest rates to push interest rates down. When they stop that buying pressure, what do we expect to happen? Bonds to fall over and interest rates to shoot. I mean, 1 or 2 percentage points, folks, if you've gotten involved in bonds down here at around a 2 or 3% interest rate in the last 10 years, you could get crushed on that. What's your plan for managing the broken wing butterfly? That's a great question. So, Sal, what I usually do, if I have a defined risk strategy, especially one like this with the risk reward being 1-to-1 here, as a matter of fact, the paradigm shifts a little bit more generally to your favor when you get a bigger credit. So with a defined risk strategy, I'm going to let the probabilities play out here. So I'm going to stay with that trade and not cover it most likely. If you are newer to trading, and this is a great question, like where should I get out? Well, on this trade, especially for newer traders, Sorry. Where are we at? Oh, I know what happened. I pulled up the other, let me find my chart. I pulled up a different chart there. All right, I'll just find it. All right. I wanted this chart so I could write on it. All right. Sorry. So we've got the resistance here. Now, I talked just like in that IBM, right? In the IBM trade, this candle looked a little bit different. And I would suggest waiting for the confirmation. Now, if we don't get confirmation on Monday, then I probably wouldn't put this trade on. All right, Sal. But if I do put the trade on and like it looks like it's going down, but maybe late in the day we get a big push to the upside, right? Like the market starts rallying. It looked like it was going to be a confirmation, and now we're getting this push back higher. And anything above that previous day's wick, pull the ripcord on it, all right? Because the pattern's broken. We're setting this up on a swing trade. The pattern's broken, get out. Now, I talked about the fact that I have a tendency to, get in a little bit early and ride these out for a defined risk strategy. I probably will with this as well. It's a risk one to make one. I might get a little bit of a push here. But when you start seeing these types of patterns at the top of these moves up here, we've seen it want to roll back over. So newer traders, anything above that previous wick. Now, even if we got involved in this trade, let's say, and we started getting involved because we were looking at, I got a green, I want the red. So you get a market move down like this, right? And now you're into profitability, all right? It's starting to look like you're winning. If we started coming down and maybe we came down a little bit more, started playing around in here, and then we started moving higher. Again, it's above the previous day's wick, which is what I would look at, okay? Perfect. Does anybody else have anything? So I don't think I did this much justice because I'll go back. You got to nail the number, meaning, you know, if you're not right, you're going to lose on both sides. So you've got to nail it right down the middle. It's got to be a very bearish assumption. With a broken wing butterfly, you have higher profit potential, right? And a higher max loss. But you also are trying to risk one to make one. And the probabilities of this being a winning trade, because, I mean, I would keep $50 if it was selling off, right? I would not take that trade off if it just sold off. I would just kind of hold on to it and let it just, you know, go down to dirt. All right. So that's your, like I said, your link there. I do appreciate you guys. Thanks for joining and sticking with me with my sweat and everything else. I didn't have to throw up. As a matter of fact, you guys calmed my stomach. I didn't really even think about it at all. It was just more the sweat running down my face. And I'm sorry for that. All right, folks, I hope you have a Merry Christmas. I'll see you next week. And one last thing. If you can't take that, take it easy. Bye for now.